It feels like the markets, if you take a look at the market reaction overnight, have essentially priced to perfection that we're going to get a good news resolution out of trade. Are you as optimistic that it's as straightforward as that, given the complexity of this, not just trade, but also strategic competition between Beijing and Washington?
I think there's a very long fuse associated with this. So it's easy to negotiate the number of soybeans, the number of cars. That part of the trade agreement can be done relatively straightforwardly, but that's only a small part of it. It's these bigger picture issues on intellectual property and the framework of enforcement. So the laws have changed in China, yes, but the question is, what will the enforcement be? We'll only be able to see that in practice, and my hunch is that the administration is going to want to keep some mechanism that they can respond with if they don't like how the enforcement is going, and that's going to be where the tension is. The Chinese are going to say, we've changed the laws, we're changing our practices. The administration is going to say, not so fast, let's see it in practice.
And we know that it's affected sentiment, clearly, investment decisions, and the way that these geopolitical uncertainties tend to. We also know that it's fed into the broader economic data, at least when you take a look at demand and trading volumes here in Asia. How do policymakers kind of, I guess, work their way around what could be a great deal of uncertainty over the next coming few years, even?
For sure, and we saw some of the tumult in the market reflecting that uncertainty. The impact of these trade disputes, at least for now, is much greater on the Chinese economy overall than it is on the U.S. economy overall. Obviously, it affects particular pockets of the U.S. economy very importantly, but trade is smaller to the U.S. than it is overall to the U.S. economy than it is to China. And the Chinese economy is slowing more rapidly than the U.S. economy had been slowing. And so there's more pressure. And of course, President Trump is someone who is a negotiator and, at least at the moment, feels that he is in the stronger position and is going to continue to press, as that uncertainty is going to be there.
To your point, in fact, the White House chief economic advisor, Kevin Hassett, seems to be pretty optimistic about where the U.S. economy is going. Take a listen first.
We've got a recovery that's long in the tooth and it's accelerating, and that's just the sweet spot for the American worker. And I think that's really the headline of the report, is that the state of the economy is strong and it's especially serving well those who most need it.
Of course, we know that global markets will not like if we don't get a U.S. trade deal very soon. But what happens to economic growth if really this deal gets delayed and those tariffs remain in place on $350 billion of goods from both sides?
So, as I said, that's important for particular sectors, and so that has a very big impact on the specific sectors where the tariffs are. But relative to a roughly $20 trillion economy, it's not that important for overall economic growth. But as we were just discussing, if there's more uncertainty, that may slow investment. And I think there are a lot of other issues in the global economy besides just the U.S. China trade dispute that have been raising some headwinds for the U.S. and for the global economy.
And Randy, of course, given all of this situation, we have seen central banks turn dovish, whether it's a PBOC or the ECB, with fresh new stimulus or tax cuts being announced in China. I do wonder, though, did this change of tune come in time, or are they a little bit late?
That's always the question of whether the central banks have the crystal ball and can anticipate everything. And even if they can anticipate, can they undertake actions that'll have the consequences at the right time? Will they get it all right? Of course not. But I do think that they've been trying to anticipate a slowdown. In the U.S., I've called it the pivot to patience, because they suddenly pivoted to talking about patience of keeping interest rates roughly where they are for quite some time. And my guess is that's exactly the same story that we're going to hear when Powell speaks later today.
The financial conditions also rebounding, but at the same time, we didn't really get particularly upbeat economic news recently. So are policymakers going to stress patience again?
Yes, as I said before, they've done this pivot to patience in December, January. I think that's exactly where they're going to be. The more recent data has come in a little bit softer for the U.S. and certainly soft data around the world. There are no rush to start moving things forward, getting back to the infamous dot plots. That's something that's not coordinated across the different members of the Federal Open Market Committee. And so that's why it shouldn't be taken as much of a signal as I think the markets do. It's reflecting just the individuals thinking on their own rather than kind of the collective sense of where things are. And so I think that's why there's often a disconnect. I do think it's likely to come down a bit, but even if it doesn't come down that much, I don't think the market should misinterpret that as the Fed's being tough. I think they should continue to think that the Fed is going to be patient for quite some time.
Yeah, and that really feeds into the market psychology of the rally that we've seen resuming. Randy, I want to throw up this chart taking a look at what American money markets are presuming over the next 2 years. They're seeing it as more likely that rates will go lower as opposed to higher, despite what we've seen in terms of the financial market rebound there. Is this dangerous? Is the idea that a Fed put or a power put is in place breeding a sense of complacency for investors? And does it also leave the Fed and other central banks with less room to be able to move if and when a potential steeper than expected recessionary set of conditions does maybe hit?
Whenever the markets are expecting someone else, whether it's the fiscal authority or the monetary authority, to bail them out, that means they're going to take on more risk because they feel that they're not going to bear the downside of that risk, and that's going to lead to trouble. And so I think it's incumbent on Jay Powell and his colleagues to try to explain why they're doing what they're doing, that it's not simply reacting to the markets, that it's not just about providing that support for a particular level in the market, but that's attention, because of course when the markets go down, that's reflective often of lower expectations about economic growth. So it may seem like they're reacting to it, even if they're reacting to the data rather than reacting to the market itself.
So Randy, you know, when last you were with us, I remember you predicted exactly what the Fed would do. You said they were going to hike and then pause. So now you're convinced they're not going to signal anything. What would it take to get them to go in either direction at this point? Would it take rising inflation? Would it take signs of a slowdown? Right now we can see unemployment staying low and wages coming up. What do you think?
I think you're exactly right. So they're going to look to see if the data are saying something's different than roughly where our forecast is. Because the forecast is for growth to continue not nearly as strongly as last year, but reasonably strongly. For inflation to be roughly around their 2% goal, but not much above and not much below. And so anything that deviates from that, a spike in inflation or a spike down towards deflation, or something that significantly changes the prospects for economic growth, that's going to get them to move, but it's going to be a high bar. They're not going to move soon.